So these might seem obvious, but they're neglected, especially the fourth point. Company value tracks oil prices, pure and simple. Sector growth is driven by discoveries. You've got to find reserves, you've got to replace reserves, or nothing happens. Simple as that. It's all about exploration. That's the grassroots of this business. Company value is driven by reserves. Again, so how does a company add reserves to their bottom line for their annual report? Well, they buy them, they transact them, or they find them. It's not complex stuff. It's not rocket science, guys. We're drilling holes in the ground and stuff is flowing out. It's really that simple. So the fourth point, one that is ignored, and unbelievably it seems, is that size matters in this business. It really does. And size matters in this business to an investor buying oil and gas stocks, or to the operator of small cap stocks. And I call it the min cap trap. It's the small company dramas of the industry. So if you take one thing away from this presentation, it's this graphic right here. This is what you have to take away. So it's a little busy, so bear with me while I explain it a bit. The axis here is the market cap of the sample companies. So these dots here represent about 250 odd companies around the world, a cross-section of oil and gas companies, listed companies, and a carefully selected cross-section that represent the global listed equities in the sector. So this is their size, logarithmic scale. That's $100 billion. That's $100 million. Here's the $1 billion mark. Y-axis is returns. Anything below this line, you're losing money over 5 years. This is the last cycle, people. This is the last 5 years of total investor returns. So that's pre-GFC, through GFC, and as we're sort of seeing the light at the end of the tunnel now, coming out of it. Bottom line, if you have money, if you own a $100 million market cap oil and gas stock, the chances of making money in the last 5 years are about 10%. It is that simple. The numbers don't lie. They are the odds, right? I mean, we've got about 40 stocks here, maybe 50. And then we've got about 4 that are in positive territory. Again, not a complex idea, but so often overlooked in the industry even that it's staggering. Mum and dad investors never think about it. Professional investors sometimes don't even think about it. There's a sweet spot though, that's the good news here. There's a sweet spot for investors. There's a sweet spot for people wanting to do deals and merge companies. It's the 1 to 3 billion mark, and sometimes slightly under it if they're a stellar performer. Let's say 750 million to 3 billion. It's in this range. You can see a density. It's a density of clusters above the positive returns mark, and a few outstanders up here. If you're doing 40%, 60% nearly. That's where the stellar performance is. It's in that range, and there's no coincidence. This all makes perfect sense. So we go back to my first illustration of the coins, right? It's a 1 in 4 chance of finding something. It's a 1 in 6 chance of making money. So I've got to drill 6 wells if I want to make any money. What does a well cost? It costs, if you're offshore and 100 metres of water, $50 million. If you're deeper, and most of it's deeper, it's up to 80 million. It's higher, it's 100 million. So when I've got $100 million, that's my market cap. What happens when I drill a $50 million well? I might have 10 million in the bank if I'm lucky. Any more than that, I'd become an acquisition target. So I drill a well, I'm worth $100 million. I go bust. The market doesn't reward me. I've got a dry hole. I've diluted all my shareholders in half. No one's going to reward me, and I'm not going to have the funds to drill another. And that's why we see these negative returns, because there's a lot of hopefuls and they just don't make it. So what happens? Firstly, let's explain this phenomenon. Let's try and put some research behind what I'm saying here, other than this graph. Why is this happening? It's just as I explained. This is an example of what has happened in the last 5 years. We've got a graph, starts at 1984, ends a year or two ago. We've got these bars are the number of wells that have been drilled in Australia. This line is the cost of those wells. So what happened in the last 5 years? That cost tripled. So this is recent, and this is why people ignore it, because it's not a trend that has been going on for a while. I mean, we've had a very steady drilling costs in Australia for the last 30 years. And if for whatever reason, and it's pretty simple what reason it is, oil's harder to find now. You've got to go out deep, you've got to drill in deep water to get anything, or you've got to get gas and develop gas, which is usually expensive. So we've got a tripling of costs, we've got less wells being drilled, it's killing the small fish. The small fish are going to be eaten by the bigger fish. This is what's happening in 2012 in M&A, in oil and gas. It's what happened last year, except the only people buying were the Chinese, the national oil companies, and the very, very large super majors. They were gobbling everyone up. In 2012, we're going to see a little bit more action, I'd imagine, from the independents, and small oil companies are going to start eating these small fish that I'm speaking of. So, what are the takeaways here, people? We've got our study findings, and for the investor, I'd stress a few small points, overlooked points that are very important rules of thumb. We want to hit the sweet spot of about $1 billion when we're targeting a stock to invest in the oil and gas space with this wonderful forward oil price curve that looks so promising. Don't be tricked by the small caps and by the allure of the 1 in 100 exploration chance. It's like going to the casino. It's hard work to make money out of it. Number 2, target companies with existing production and cash flow, that's obvious. Number 3, a measured exploration portfolio with good solid M&A activity means these guys are replacing reserves. It means they're adding value to their company. You need to invest in that. Avoid the super small guys, avoid the min caps, and really avoid the super majors because it starts to flatten off. It's pretty safe. But this tails off. These are the super majors. They're just these guys out on the fringe, big boys above $100 billion. And they're conservative and their returns are conservative. You don't get any 40 to 60 percenters in the super majors like BP, like Shell, like ConocoPhillips. So doing the deal, our findings. Life's tough for the little guy and the small fish get eaten. So rising entry costs, rising drilling costs, and price pressure spur M&A activity, and that's what's happening. Oil and gas is tougher to find these days, and drilling costs more. The 2011 acquisitions, as I said, are dominated by the NOCs, and next year we're going to see independents buying up smaller guys. It's getting in the middle of those deals that earn people money. So a rising oil price is an added motivator for this, which swings all these things a lot faster. A merger is strength in numbers, guys. The whole is greater than the sum of its parts, and that is so true here. Instant value creation for a well micromanaged merger with good execution. So, having said all this, how do we identify opportunities? Where do we start with all this? And this is where Wesvault Analytics comes in a bit, and our data provider and our partnership with you are, who I'm going to hand over to now. He's going to give you a brief live run-through of the kind of data we crunch and the kind of information we look at to provide these sorts of insights.
Sure. Thanks, Lynden. Good evening, everybody. What I'm going to do here now is I'm going to give you a very quick demonstration of an online platform known as the Oil and Gas E-Track, which has been developed by my organization Global Data, which will primarily help you identify where you get the $15 per barrel deals. It'll also, through this, I'm also planning to demonstrate to you a few other aspects in line with this particular demonstration in terms of identifying the stocks, in terms of identifying which companies have M&A activities, etc. So I'm going to first start off with the deals, primarily in terms of the M&A activities, how we came across this particular number of $15 per barrel.
So when you're buying, guys, when you're targeting stocks, when you're doing deals, relative pricing is important. What are things to trade at? What are you meant to pay? What do you sell for? Simple as that.
So we have this particular section where we provide the average per barrel cost of acquired oil and gas production and reserves. This $15 per barrel, we typically look at it in terms of the 2P value of reserves.
So what you are bringing up here is the average transacted price per barrel for the different regions of the world. So earlier I mentioned that oil and gas companies and assets, they trade at about $15 per barrel of oil equivalent. So that's oil and gas, rolled into the one sort of metric. So $15. $15 is the magic number. A little bit higher in South and Central America last year. That's probably because of a massive discovery they had out of Brazil. I can't remember the exact number. It was a lot. I think it was close to 1 billion barrels or something extraordinary. They thought there was nothing like that left, but there is. So it drives up the price in the region. Everyone thinks it's a hot prospective spot. They start buying. Price soars. Asia Pacific, sitting at the $15 a barrel. To be honest, that $15 a barrel component is really supported by Australia. Australian assets transact for quite a bit more. They ride at a premium of about $20 a barrel. The rest of Asia is a bit lower. It's 11, 12. So the Asian price for valuing stocks is, if you go look at their 2P reserves figure, and it should work. You should back calculate it through the enterprise value, and it should come out